Hi everyone, so let's now focus on a key macroeconomic objective, which is increasing economic growth for an economy. This is simply referring to increasing GDP within an economy over a given period of time. Now, of course, it's got to be inflation adjusted, so it's the increase in the real value of the goods and services produced by an economy over a period of time. There's a number of key benefits that can be cited when it comes to increasing GDP. Firstly, increasing living standards, that people's standard of living will become better because they're more likely to be in employment, they're more likely to feel good about the economy and their job stability and security, so that they're willing to actually go out and spend. And so there'll be a rise in consumer confidence. Now, because of that, it can also help to reduce a certain degree of inequality as well, by ensuring that people are actually able to find decent work to actually engage with, rather than just relying upon welfare benefits. Further to that, these rising living standards may mean that there'll be increased demand for normal and luxury goods, those goods with positive income elasticities of demand. Second point, that there may well be increased investment in capital goods, that is, goods that are used to produce other goods by businesses. So there may well be increased investment taking place as a result of the increased economic growth. So firms feel more confident because consumers are willing to actually go out and spend. And this is known as the accelerator effect, that increases in GDP will give rise to increased investment. Then there's the chance for greater export revenue, and that really is about, it depends on the nature of the economy and the way in which the economy's GDP composition is actually broken down. So for instance, if you look at China, if you look at Germany, those economies have a lot of income coming from their export sectors. Their export sectors are very, very important to their economies, and they both run trade surpluses, i.e. they export more than they import. So one of the key reasons why they experience rising economic growth is because of their export sectors. And if GDP is going up there, then export revenues are likely to increase, again reducing potential unemployment. Further to this, there's the chance for a fiscal dividend as well. And the reason for this is due to the automatic fiscal stabilisers. These fiscal stabilisers simply refer to the fact that your tax take and the government spending is likely to be lower during a period of sustained growth. Now, the reason for this is that you will have to make less payments in terms of welfare and unemployment benefits. Further to that, your tax take from people in employment will be higher, and so will your taxes placed upon businesses' profits, i.e. corporation tax. So that can also provide that dividend for the government to help manage their fiscal finances, that is government spending and taxation. Next up, the provision of public and quasi-public goods. Really, this is just referring to the fact that the government is now going to have increased money available to actually improve provision of government provided goods and services, such as education, healthcare, as well as other areas such as roads, street lighting and so on. So it means that there can be an additional gain there, and again that can actually help to improve economic well-being, possibly increase life expectancy and so on. So there can be a number of benefits that come around as a result of this. If we move on to some of the costs here, we can see that there's a chance for increased inflation. However, primarily this would come from demand pull inflation. So as the total demand in the economy, or aggregate demand in the economy, increases, then there's likely to be demand pull inflation, and that is that prices just end up getting pulled up because of the excess demand in the economy. This needs to be carefully managed. You don't want inflation becoming too high, because you want wages to be able to keep up with a given level of inflation, and you want inflation to be fairly stable. so that it's more predictable for consumers and businesses in terms of planning their investment. Okay, now further with the point regarding increased consumption is the fact that some people may feel so confident that they actually choose to take on more debt, so they actually increase their debt liability. This may also happen with firms that decide to take on more debt, and this can pose a problem and it can pose a risk for the economy. So this needs to be carefully managed to ensure that banks aren't taking excessive risks, and neither are their customers. Okay. Further to this, there's the fact that within the UK, our economic growth tends to be accompanied by increased consumption of imports. So we tend to import a lot of consumer goods, and as a direct consequence of our growth, consumption on imports actually rises, and that means in effect money is leaving the economy. And of course means that we run a trade deficit. Okay, then there's the chance of negative externalities. These are third-party impacts as a result of a transaction. So examples would include things like congestion as well as pollution, and possibly resource depletion within some economies where resources are just used up and there's none left. So that whole sort of process of driving towards greater and greater higher levels of growth can have a significant impact on the environment in which people live, and those are negative externalities. Okay, then there's the final point that we've got here about the impact on inequality. So it depends how this economic growth is managed, but certainly what has tended to happen is those who are most well off and own a lot of assets experience big increases in the actual value of those assets, whereas those people that are asset poor, they tend to be left behind. So there can be an increase in inequality, disparity, growing disparity between those two groups. Okay, so let's round this all off here by looking at some evaluative points. If you've got an essay on economic growth and its desirability, we can see, generally speaking, it is quite desirable, but it does need to be managed carefully to ensure that it isn't becoming an unsustainable boom. So it very much depends upon the rate of growth and whether it is in line with the trend or whether it is above trend. Above trend growth would suggest that there are potential concerns in terms of debt build-up and speculative activity. Okay, further to this, you've also got to think about, right, how does economic growth actually conflict with other macroeconomic objectives? We've already mentioned the chance of increased inflation. Further to this, there could be, as with the UK, increased consumption of imports, and that may worsen the trade balance. Okay, next up, what is the real priority of the government? What should the government be focusing on and why at any given point in time? This is very much going to depend upon the actual circumstances for the economy. But when it comes to LEDCs, it might be far more important if they actually focus on other economic development measures rather than simply focusing on economic growth, such as the Human Development Index perhaps, which looks at life expectancy and education as well as actual standards of living. Okay, finally, how sustainable is the growth? So how well are resources being managed to ensure that environmental degradation isn't taking place and that there's no resource depletion? Right, okay, I hope that's all right, guys. Thanks a lot.